Going live in a second.
Okay, we're good.
All right, we're live.
All right.
Thank you everyone for joining us today. Thrilled to have Derrick Gruner from RWA Group, a lender on the lender side. Now, this is a conversation I've been looking to have for probably 6 to 7 or 8 months. Many of you don't know, my background was in finance when I first came out of university and ended up in maintenance right away. So, but still have always kind of like, been a reader, a follower, and a listener of finance, specifically around economics, markets, all those things. Love having the macro conversation and what that impact is at the micro level. Part of the things that we've done really well is being able to capitalize on macro movements and being able to exploit white space prior to it being kind of like realized at the micro level, which has been fun to do. And so got a chance to meet Derrick by chance, sitting next to him at lunch at SFR West. So shout out to IMN on that event. It was a great event. Yeah. We got a chance to talking. And the interesting thing about our conversation, we started out just chatting about obviously getting to Hell Yes and the sales show, Derrick's energy, you'll hear that today. And talking about, well, what is it like from the debt side? Because ultimately, at the end of the day, the magic of real estate is leverage. And the magic is why it makes it such an incredible wealth creation vehicle for everybody on the planet, is you can lever up what you already have with someone else's money and then collect debt cash from somebody else to pay off the debt and keep a little bit for yourself. In the absence of that, real estate becomes a pretty tough business because of all the things that are real estate related. And so was thrilled to be able to kind of have that connection and start talking about debt because of the effect that debt has. Now, what's interesting about debt, and we talk about, you'll hear underwriting all the time in terms of a conversation with anybody at the asset manager level and up. They're looking to underwrite their properties, especially this time of year. There's all these underwritings are happening and it's all going through. And ultimately, all of this needs to hit a debt seller, right? A provider of debt. And debt is an interesting concept because it may feel like it's something that is, a necessary evil, but actually it's a wonderful, magical thing that can be used when used properly to amplify your earnings and to create liquidity moments and to be able to exit your position, all these different things. But it has to be done the right way and it has to be with the right partners. And so debt as a construct is one of the 3 legs in real estate in terms of being able to make it happen. If you don't have debt, it's very difficult to make money in this business. And then ultimately, debt helps get things done. If you don't have debt, you have very little construction. If you don't have debt, you have very little operations. You have very little ownership. Very difficult to even scale up the businesses that serve the properties. So as an intro, got a chance to meet Derrick. Derrick's from originally, great background with Genesis, Apollo. What was one of the original ones that you were in?
Started at Anchor Loans.
Anchor. That was one, Anchor Loans. And what's grown this whole SFR BTR business has been the availability of capital. Now, flash forward to 2022, when capital became really tight because interest rates, Feb 2, 2023, when the interest rate, or 2023, when the interest rate kind of started going up. And then by the end of the year, 2023, we're looking at an 8x increase on the interest rates. Debt became really hard to available, and the lack of availability of debt, compression of available liquidity, the money supply shrank, all these things shrank, but debt was still chugging along.
Right.
And that's right. The conversation that we had to open the conversation was, are we moving into a debt cycle, or are we, continuing along with our equity cycle is how we started it? Because a lot of the world that we look like right now may or may not, depending on the data you're looking at, the point of view, look a lot like the early 1980s, right? Where we've got political calamities going on. We've got a one-term president. We've got inflation that was really high. With interest rates that were really high. And there was the debt bond cycle of the mid 80s. And so that's kind of how we started our question. Our conversation is around like, are we moving into a debt cycle? What does that mean? Or. Right. And so that was we kind of started the conversation around where we're at to think about how debt influences what we do in the world. So if you're listening today, you don't, maybe you're a maintenance side folk or site level folk, or maybe you don't have you don't necessarily think about things this way. I really want you to listen closely to this conversation, principally because the way that debt leverages up wealth can be one of the most important things to learn before you go on holiday this year, before you think about 2026. And Derrick's kind enough to come on the show today and talk about debt and specifically around they sell debt. Well, how do they differentiate around debt? Now, as we all know, this is a getting to hell yes conversation, and there are hell yes buyers in the debt side of things. And think of a buyer as like somebody who's seeking to get debt capital to be able to build something or finance something. And so it's not all debt is created equal, and not all buyers are created equal. We'll talk a little about that today. As always, this is brought to you by IRCX. IRCX is AI remote property management software, so you can inspect, you can triage, troubleshoot, scope things all remotely, on site, or automatically with no app to download. And if you're listening today on the live show, any questions you put on there would be wonderful. We always love the engagement. If you're catching this later on the live, add any comments. Both Derrick and I will get notified and we'll be able to jump in the conversation. And if it's the podcast or on Apple, please subscribe, download. That always makes it a whole much easier for people to find us and to listen to conversations like that, like this. So without further ado, Derrick, thank you so much for the time today. Thanks for, being fortunate enough to, or maybe I'm fortunate enough to run into you at the conference and starting the conversation around a little bit about yourself and then how you got into this role. I mean, a long history of being a GC, being a loans officer, being a compliance officer, both sides of the U.S., LA, and Pacific and the East Coast. And how did you get in this role today? And then specifically, what's the problem that you guys are solving today?
Listen, first of all, Guillermo, thank you very much for the invitation. Really a pleasure to bump into you organically in Scottsdale at IMN. And I agree with you. Kudos to the IMN folks doing a really great presentation as always. I know you got a chance to sit down with Steve Leonard during the evening, and Steve runs that show. And I've known Steve a long time. He's one of the best event runners in the space. So I agree with you. Great event now. And again, you set the table nicely there. One of the things that you talked about was how interest rates affected the market. And I'm actually going to give you a contrarian view about how interest rates really didn't impact certain parts of the market.
All right.
Debt more expensive. But before that, let me just briefly dive into my background. So I've been a practicing attorney now for about 20 years. But I started my career decades ago as a retail loan officer, worked my way into being an account executive, regional, and then a little bit larger than that. Ended up going to law school in the early aughts. Got out of law school, was fortunate enough to know everybody in the space. Again, on a national level, didn't take too long to put together a book of business. About 5 years out, I became partner at a AV-rated East Coast law firm. A few years after that, got in contact with a young dual Reg D fund called Anchor Loans, which was at the time one of the 800-pound, still is one of the 800-pound gorillas in the space. They brought me on as their first general counsel. I helped create their legal department. My buddy Puyan Zavari is still the general counsel there, and I hired him right out of law school. He didn't think he would pass the bar on the first go. Of course he did. I told him day one that that there's no time off for good behavior in Anchor Loans. 13 years later, he's still in that chair. So.
Oh man.
That's kind of how it goes. But and then a number of us peeled off of Anchor Loans and started Genesis Capital. And so I was there along with a couple of other folks I'm going to mention in a second at the very beginning of Genesis Capital. We went through a couple of different iterations. Genesis Capital ultimately, as everyone knows, exited to Goldman Sachs. And then, various players kind of went off and did other things. And so the coincidence is that two of my partners, our founder, Justin Mitchell, and our COO, Justin Atamian, are both Genesis Capital alum, right? So we all were part of the inaugural class of Genesis Capital. A lot of our senior VPs and directors on down are also folks either from Genesis or from when Justin and Jason left Genesis, they created Quanta. So a lot of those folks are with us now. We're very fortunate to have, as a group, some of us have 15 plus year histories. So it's a great organic organization. We all know each other real well, including knowing one another's idiosyncrasies, which is really important for, right? Exactly. Yeah. Grind down those idiosyncrasies as soon as possible, address them, right? And that creates a much better environment. And, one of our ethoses at RWA Group, besides being a lender in the space, is also to have created an environment where we wanted to, the type of place where we would have wanted to work early in our careers, right? Like we've been successful at doing that, creating a cohesive team. And obviously, we're very fortunate that we've got talent. And look, we recognize the fact that talent can go anywhere, right? It's not just what you pay talent; it's how you treat talent. And so we try to go out of our way to really make our talent feel like they are part of the team, because the truth of the matter is they are, and the real truth of the matter is without them we wouldn't have a company. So there's a lot to be said for that. So, and RWA Group is very similar in the mold of the Genesis Capitals and the Anchor Loans of the world. Again, a lot of us came from that. A lot of our borrowing base are folks that have been with us now for close to a decade. Our focus is all tier one operators, across the U.S., all the major MSAs, and these are folks who are prolific builders, prolific flippers, and they are solving the housing crisis one house at a time. And we're happy to be their debt partner. So with that, let me kind of dive in on a couple of different things. So first of all, I mentioned a contrarian view, right? So
yeah, tease me.
Interest rates are important, no doubt, right? And your whole sort of sermon about the importance of liquidity is super important, right? Because debt capital is a lot cheaper than investment capital, whether it's mezz or whether it's friends and family or whatever. I mean, you pay really high pref rates for that capital,
especially if you're doing well.
100%. Oh yeah, absolutely. Okay. You're right. It's expensive, whereas debt's relatively cheap. So the idea is, listen, whether you're building to rent, then you're going to be focused on your cap rates, or you're building as an exit, then you're going to be focused on your pro forma, whatever it is, right? The idea is to get your cost of funds down, and that's true across the board. So cost of funds is an important thing, and debt answers that question. So some of the biggest things that we noticed, right? So I'll talk about, for example, when interest rates shot up. Our borrowing base is like everyone else. They're interest rate sensitive, but they're not as interest rate sensitive, right? And so I'm sure a lot of our borrowers would disagree with this, but I want to put it in the proper perspective, right? This money is 12 months on the inside and 24 months on the outside, right? So typically our loans are 12-month loans, 12-month loans, many of them mature before that. So when they're looking at a pro forma, yeah, they're looking at our cost of funds, but they're looking at our cost of funds against the backdrop of the short duration of hold. And that's really important, right? So when interest rates spiked, it created a huge problem with a lot of the long-term product, right? The DSCR with the 30-year amortization and a 10-year maturity. It didn't impact us as much. Where it impacted us was the exit, right? So the build to sell part of our business really, I wouldn't say evaporated, but really it was reduced very quickly. And that's where there was an impact. But the development community is a very nimble community, and right away they went from build to sell assets to build to rent assets. So because they recognized, as we do, that the underlying fundamentals of the housing shortage are real, and it doesn't matter where you are, who you talk to. I can't comment as much on the situation in Canada, although I do know that you've got major market shortages in places.
Oh no, we're super short. We're super short.
Okay, there you go.
We had a massive immigration boom for I think last 4 to 8 years, and we're way worse than we were even before.
Right, exactly.
Okay. And a shorter construction season, and less builders, and less. The same story. It's the same story.
So exactly. So our dynamics were a little bit different here in the U.S. Our dynamics were that after the Great Recession, people just stopped building housing. Mm-hmm. And I remember, several years after I want to say it was like maybe 2011 or 2012, the first time I saw a subdivision under construction, I was like, right? It was like, wait, what is that? Oh, hold on a second. That's a subdivision. They still make those? It's just like one of those weird things.
It's like cranes in the sky, right?
100%. Right. 100%.
Cranes in the sky, you're like, whoa, I haven't seen one of those in a while.
Listen, when I moved to Miami, when I moved back from Brazil in 2008, the construction crane was the city bird of Miami. I mean, they were everywhere. And then by 2010, a lot of those buildings were black. The only thing they had was the emergency lights on the top, but other than that, they were essentially shrink wrapped, right? And it was wild. And so you're looking out at all these dark towers. I remember seeing the same thing in Vancouver. So I mean, it's sort of right. And so the bottom line is that there aren't enough beds for heads, right? And so our dynamics have been a little bit different in that, yes, immigration's been a factor. Yes, family formation's a factor. Also, the paucity of construction after the Great Recession a factor. So a little bit different mix, same result. So it doesn't matter who you talk to, you're going to get a national number somewhere between, conservatively maybe 4 million and ambitiously maybe 6 million, right? But it doesn't matter, because if you think about that against the backdrop of housing starts, right, on a national level, any given snapshot, any given quarter, any given month, any given anything, you're still looking at about a 10-year build out just to meet the housing demand that exists today.
Mhm.
And that doesn't take into account, whatever immigration policy becomes, in-migration is still going to be a thing, right? It doesn't matter how that is. And even if you take migration and immigration off the table, you're still going to have family formation. You're still going to have, babies being born, right? Children coming of age, graduating college, getting married, forming families, right? So dynamics are going to change a whole lot, and they certainly aren't going to change enough where if we stop building housing, that all of a sudden that 6 million is going to evaporate because there's less demand. It's just not going to happen. So dealing with that reality for us is, okay, how do we then equip our borrowers with the tools necessary to continue to build our way out of this housing shortage, right? And particularly in acute housing shortage states like California, like New York, like Texas, like Florida, right? So those are sort of our I would say our biggest states right now. But the same applies in places like Tennessee and the Carolinas, right? It's not just
and they're less equipped from an infrastructure perspective to actually create the housing. Like, you can build a house, and I can't speak for this directly, but they're given the years of development, and I'll say enterprise infrastructure in place, developmental infrastructure in place in Texas, Florida, California is hard to talk about, but like in those states, at least you've got the people to do the work and the companies that do the work. Because a builder doesn't build a home; it's all the trades and vendors that build the home,
right.
And so they're the ones that actually swing the hammer, and so that infrastructure is even tighter in the North Carolinas, the South Carolinas, the other, Arizona for sure, right? Those are really, really tight from a labor perspective. So maybe the next show we do is how are these going to be built? Because there's not enough kitchens, not enough bakers to make all the buns that we need to eat.
100%. 100%. And you bring up a really good point. After the Great Recession, we lost something around, and I don't remember the exact statistic, but during the Great Recession, we had an attrition of around 30% of the construction labor force, right?
Yep.
And I don't know if that number is 100% correct, but I bet that's based on recollection, but I'm pretty sure it's.
Well, it goes along with the data that every 5 leaving, 1 was coming in. So it's like 20%, 30%. That's the number. You're not going to bet against that.
That's right. That's right. So, okay. So now you're 100% correct. So a lot of construction, particularly in the last couple of years since, post-COVID, right, it was a combination of supply chain. It was a combination of, labor shortages, right? And those labor shortages and those supply chain issues, although the supply chain issues aren't as acute as they were, they still show themselves from time to time.
Yeah, it was a classic supply shock. It was a shock, and we need to catch up.
Absolutely. And I think the global supply chain did to a certain extent, right? But it also created, a hunt for alternatives, and it created some really, I would say, I hate to use the same word twice in a sentence, but some very creative solutions to that, right? So, for example, one issue that we ran into early on after COVID was, sourcing the exact things that you're talking about: washing machines, dryers, air conditioners, stoves, kitchen kits, right? It seems like that we take that stuff for granted, but that stuff evaporated pretty quickly. And so some of our more forward-thinking developers started to warehouse that stuff. So we had one developer in particular. I remember touring his, I wouldn't call it a warehouse, right? He had a construction site. He was doing horizontal multifamily, built to hold. And I went out and walked the site, and he had all these cargo trailers, right? The big cargo boxes, and they were filled with basic things: air conditioners, windows, stuff that you would just take for granted. And he said, listen, Pella windows are difficult to get a hold of, right? And I don't want to have to use a cheap Chinese knockoff. So, I've got to have in Florida, Texas, I've got to have hurricane glass, right? In Louisiana, I got to have it. So, that was an interesting sort of layup. Again, some of that stuff has worked itself out, but the labor issue is perennial. And, again, migration is certainly a factor, right? And so how the current immigration policies are impacting, construction, it's TBD. I mean, it's, and again, it's not a function of how, it's not a function of what immigration policy is. It's a function of how immigration policy is applied.
Yeah. I mean, and that's the gap between what you say and what you do, right? I mean, And then again, regionally, it has its own nuances, right? So it's like that's for a different show because there's no, I don't know, it's better to talk about the impacts of it all than actually the policy because like
yeah, agreed. That's you can do a whole show all that time, right? Getting back to I appreciate that, but getting back to your original thesis, right? Whether we're in a debt cycle, I think it depends, right? In other words, I think the argument can be made both ways. Now, I would say to your earlier point, right? Does this rhyme with the early 80s? Does it rhyme with the mid 80s, right? Like all like 84 through 87. I see similarities, right? I also see similarities in the run up to the Great Recession, but with fundamental differences, right? And so one of the fundamental differences just in the debt market overall is that homeowner liquidity is substantially higher than it was in the aughts leading up to the Great Recession, right? And so you don't see, I remember like the 80-20 products, right? 520 credit scores or 580s or whatever it was, right? And they were, getting 100% financing to buy non-owner occupied on a no income verification loan, right? And so that was an actual thing. And so you had all these houses, especially in places like, suburban Las Vegas and suburban Phoenix and Lee and Collier counties.
Is it Pleasanton, California, or that? Yeah. Stockton, California, ground zero.
It's Stockton, right? Stockton, when I think it was one of the first bankruptcies filed by a municipality, right? So, I mean, you had real fundamental issues. The issues now are different, right? And so, in the housing shortage, to some extent, is exacerbated by this, right? Or certainly aggravated by this, which is you have people in their homes that have a lot of equity in their homes, but they're fundamentally trapped because they're in, a sub 4%, mortgage, right? And right now, even with a little bit of attrition in the 10-year, you're still seeing yields at this morning, I think it's like 4.17 or thereabouts. So the point is you're still seeing 30-year rates that are substantially higher than they were years ago, right? And so if you're a homeowner and you're and I say trapped because the reality is you can stay in your home with a mortgage you can afford, but to buy that same house for those same dollars in that same MSA, your housing payment's going to go up $1,000, $1,500 a month.
The pricing and the financing.
Correct. Exactly. To say nothing of, increase in insurance, increase in real estate in certain markets, right? Or, even HOAs in states like Florida that are reacting to mandates, that are, requiring certain types of reserves, and they're requiring that CapEx be moved forward and that OpEx be accounted for and so on and so forth. So my point in all this is that, yes, you could make the argument that we have markets that are similar to the early aughts and similar to the mid 80s, but there are also fundamental differences, right? So there again, during the leading up to the Great Recession during the aughts, I mean, again, we had, I forget what the figure was, right? But the amount of liquidity that somebody had in their home on average was less than 10%, right? It was
really
low. From what I looked at, and I think nationally it was probably still less than 20. Now that number's much larger. Most people have a significant amount of equity in their properties. I saw a survey, and I'm sorry, I should have written all this down, but I saw a survey the other day that was talking about home ownership in the United States that had PMI, private mortgage insurance, right? And so the threshold for PMI is that you have the evidence that your appraised value of your home is less than 80% of that your mortgage balance is less than 80%.
Yep.
So the percentage of non-FHA, right? So taking that out, non-FHA, non-VA, percentage of homeowners with agency mortgages that no longer were subject to PMI was one of the highest that it's been in decades. So to me, that's an indicia of a market that's a lot less mobile than it used to be in terms of people moving from home to home. The market's, again, it's much less mobile than it used to be, but also I think there's a higher, again, how the statistics actually shake out, I think it's irrefutable that we have higher equity. Homeowners have more equity in their homes today than they have for a very long time. And so from my standpoint, right, and from our standpoint is looking at debt. Now, the disclaimer is we don't do consumer debt. We only supply capital to builders. But we're mindful of the fact that these builders are building end-use product, right? And so, we want to make sure that we understand the feasibility of exits for these builders, right? Are they building a home that meets the market where it is?
This is the interesting part, right? Because you're getting into the business of the builder, which gets into the operations of the functions, the operating of the units, right? So this is the part that's kind of like where everyone's starting to kind of like get their head around. I think we'll see a lot more of this in 2026. Is, debt's got the wallet, and so debt has I'll say that I haven't heard from anybody anecdotally that the bankers are asking about how we do things or where we're building things.
We are
starting to hear that more and more, is they want to know where we're building things, but then eventually they're going to ask, how are we doing things? Because ultimately your capital is at risk for your LPs. And so since you've got the LPs, you've got your risk tolerances for how you want to deploy capital, you're either going to see a consolidation of who you're going to deploy capital to, or you're kind of like the rules to be able to borrow the money, those are all going to change too. And
yeah. So that's a great point, right? So early on, I mentioned that, sort of like tiers, right? So you have sort of 4, really 5 tiers of borrowers in our space, right? So the top tier are the folks that have done, 10 plus. They're like we call them like the tier 1 prime, or whatever you want to call them, the exceptional super borrowers, whatever you want to describe it. They've done 10 plus properties in the last 2 or 3 years. Many of these folks have done 10 properties in the last 5 months, right? I mean, so they're prolific builders. Behind that, you got the tier 1, which is folks who are done, call it 5 or more exits in the last 2 to 3 years. And then it kind of goes down from there. So the market that we don't play in is sort of the tier 3, tier 4. So think of the tier 4 as, a brand new market entrant, right? Someone who's just getting into the space. Now, there are compensating factors. You can have, a guy or a gal who's been a general contractor for the last 10 years, and they've done a lot of projects. They've just never been the sponsor. They've never been the person that's actually, okay, now it's my project.
You don't want a hobbyist, right?
Exactly. Right. That's right. Or someone who's trying this out for the first time. Listen, there are a lot of organizations out there that'll do that risk tolerance, but we cater to a little bit different market. So that tier 4 is, like you said, new market entrants, hobbyists. That tier 3 is folks that are just kind of getting up and going, and then they get the tier 2.
Is that just to kind of tie together people that aren't familiar with the LP model? Is that tied into your kind of like your bylaws in terms of how you deploy capital? And is that kind of put into how you guys raise capital for the fund?
That's a great question. So we set out, and keep in mind, we've been doing this a long time, right? So we write our own guidelines, and we go to our LPs and we say, these are our guidelines, right? This is how we're put together, right? And so a lot of our capital tends to be either silent capital or very quiet capital, right? What they're looking at is they want us to manage the assets, and that's really what the focus is, right? So, but to your point, having a very clear picture of how we manage risk, right? And we are very credit centric. And so that goes into your questions about, how involved are we in the builder's process? And the answer is very, and we always have been, right? Because, one of the things is because we are working with borrowers who are constructing projects, they'll provide labor, material, and services to the subject property. They'll come back to us for a construction draw. Then we'll verify that work has actually been done, that the provision of labor, material, and services are accurate. That, like I said earlier, they said they put Pella windows into the project. They actually did. They said they put quartz countertops. They actually did. Things like that. Also, we can see distress. We can see distress right away. We notice distress in a couple of different manifest in a couple of different ways. For example, distress might manifest as there's been a pronounced gap in the provisional labor, material, and services, right? Unless it's a super borrower that funds everything and comes us at the very end to get their entire construction draw for everything that they've fronted. But that's an exception. But typically, the periodic construction draws, right? We'll see if there's a lag, or we'll see that, that, like I said, there's a paucity of provision of again, labor, material, and services to the subject property that will show us distress. So we are definitely engaged in what our borrowers are doing, and it goes back to that sort of feasibility thing, and that folds back to our underwriting guidelines, which we have told all of our partners and our borrowing base, right? I mean, we're not, we're up in kimono with our guidelines. We're like, hey, this is what we do. Our market is almost exclusively that tier 1 prime, that tier 1, and that tier 2. And so, yes, it gives our limited partners a certain view on, how we manage risk, right? And again, how credit centric we are. And so also the flip side is the to our borrowers, right? What the value proposition is there is that it's a known quantity. So our 2 strengths in the space are certainty of close and speed of execution. What I mean by that is, we're not LOI, letter of intent, right? We're not LOI shopping. If we give someone an LOI, that's money. They can go to the bank with that, right? We're going to do that project. And the reason we can do that is because we're very credit centric. We've underwritten the file. We've underwritten the borrower. We understand the project. We've seen the feasibility. We've heard the story for why that project makes sense wherever it's being built. And also keep in mind, a lot of our builders are high end. Right. So they're building, we frequently see, $10+ million looks. Right. And we've had a couple of that we've gone through. We very frequently see $3+ million deals. Right. And so, again, these are a little bit higher end. And so when you've got that kind of money out, you have to make sure that that's a asset that's going to perform.
And for everyone listening, the concept of position is something that is like, I'll say it, like you're not in the home building business or the home ownership business. You're in the real estate business. You're in the lending business.
Right.
And so the concept of positioning, if someone does go, if a project does fail, the position of the debt holder is typically first position, and then you've got investors, and then that cascades from there. And so first position means that that's your problem first. And then it's up to you to figure out how to work with an agent to figure out how to recoup as much as you possibly can. And then whatever's left over goes back to the investors. And so if you are an investor and you've borrowed money and the project doesn't work out, then that money is liquidated, the debt gets paid first, and you're in the first position. So the reason why de-risk is such a high profile activity for a lender is that the lender does not want to be in the home selling business.
Right.
Especially homes that are half built.
That's right.
Right.
Well,
because
that's
a bad business.
Right, Guillermo. No, that's a really great point and a very important one as well, right? So yes, we do factor in, the way our loan documents are written, we have step-in rights, right? So we do have the ability for a busted project to step in and complete the project, and we will do that, right? And so the last thing we want to do is go to market with REO that's a half-baked project, right? That's just going to be a loss all the way around. So a lot of times we'll try to, but fortunately we've had very, very few defaults over the last, over 6 billion originated. Historically, I think we've had a default rate of less than 1.5%, and we've had zero capital loss. And so the way we manage that is, that goes back to twofold, right? So we talked about the credit side of the business. Now let's talk about the asset management side of the business. I got a little bit into this when we were talking about, about how involved we are with right. Yep. And the important sort of veneer on that, Guillermo, is we think of this as a strategic alliance partnership with our borrowers, right? Because these are annuity borrowers who we've been working with for a long time. These are established relationships, and it's that that flow, that strategic alliance that really makes the partnership work. And so it's the reason we have so few defaults, and the reason we have no capital losses, because again, very credit centric. We're very involved in the projects, and if we have to step in, then we will. But the idea being is, no, we don't want to be in the property management business. We don't want to be in the real estate holding business. We don't want to be in the real estate sales business. We are lenders, and that's all we want to do.
Yeah, and so and I think that's until you really understand the concept of position and disillusion and all those things. It's kind of easy to misconstrue why there's such interest in the lender in progress and where things are at. But obviously you recognize that worst case scenario is actually a very worst case scenario for your business, because it's not where you want to be. So it's not, and maneuvering out of that costs you money on the original deal, and then costs you money on an operational perspective because it's not what you want to do.
Exactly.
Right. And so that makes sense. And so that kind of adds in, kind of like credentializes the approach to working with people who are not doing it the first time, like no hobbyists. You want to work with people who know that understand the business, understand the P&L. They understand the importance of debt and why it's a partnership, right? There's a hell yes kind of point there. And then getting into the fact that they actually understand how covenants and all these things all work, because you're guarding the capital of the people that have invested in your fund.
That's right.
And then you've got an obligation, a fiduciary, because you're financial, take other people's money to be able to steward towards the returns that they're going to make.
That's exactly right. 100%. No, we do have, yes. I mean, it's certainly a literal fiduciary in terms, or maybe conceptual fiduciary, even if not a legal fiduciary. But yes, we have a responsibility to our investors to be good stewards of their investments. And, a lot of our investors, both on the private side and on the institutional side, they they're drawn to us precisely because of that depth and breadth of experience in managing the assets, right? So at the end of the day, the asset is a loan itself, and a performing loan at that, right? So it's incumbent on us to make sure that those loans perform, that they pay out, and that we step in and resolve if there's not if there's any kind of distress, right? So again, yes, it's incumbent upon us to be good stewards of our investors' money, whether, like you said, however that LP relationship is. The answer is the same. All our investors want to see at the end of the day is a coupon. They don't want anything else. They don't want any headaches. They don't want any noise. They don't want any static. They want a return, and it's our job to deliver that.
And I mean, and I'll guess, like, are you in a GP position in the fund?
What's that?
You in a GP position in the fund?
We are. Well, it's a little bit different. So we're a fund manager. So think of it as a collection of LPs. Okay,
collection of LPs, and then when that fund closes and turns over, like, you get paid the gap between what you promised people you were lending towards and the people that you lent money to. Like the LPs that invested in the fund and their coupon, and then what you were able to rent to lend out, and the gap on that goes directly into how you guys get paid.
Yeah, that's yeah. I mean, it's yes, that's one way of looking at it. So there's a little bit more nuance to it, but yes, at the end of the day, our value proposition is that we can deliver a return, a targeted return to the investor. Again, whether it's an individual investor or an institutional investor, that we can deliver the targeted rate of return, and then there's once we get above that hurdle, right, then there's kind of a split, right? There's a promote that gets split up, right? And so the idea is to have that alpha, right? I mean, look, nobody works for free. So at the end of the day, we're looking for that alpha, but we don't get that alpha until we've provided that to our investors. Again, whether they're institutional investors or private investors, right? And again, there are a lot of different layers to that, right? There's, and also, we also, deployed, we also managed that. We also leveraged to a certain extent in some of our funds precisely to make that yield.
And so what's interesting is that like there's two customers here, right? There's the customer that you're raising, or you're a seller. You're a seller in terms of raising capital, and that has a commitment to that. And then you're also selling the debt in the marketplace because you're competing for projects. And so ultimately it's a marketplace that people don't fully appreciate, because the money didn't come from heaven. It came from something, someone, somehow. Yeah, right. And it has an expectation around return. And so I think it's interesting to have the understanding that the hell yes on the fund side is a function of how you deploy capital, manage capital on the, I'll say, the operations side of things.
100%.
And that's what they're buying.
Right.
Like, they're buying a commitment to a coupon that has a low probability of default. And I know I'm going to get it because I've got pensioners, I've got all these other things I got to pay for. So they've got a cash flow obligation. You're able to deliver on that cash flow obligation as return on their fund. That happens there. And so there's hell yes moments in that side of things, because they actually want to put their capital and deploy it in a place that's going to come back to them because they've got their cash flow obligations. And then your side of things, on a debt deployment perspective, you've got to choose your projects, and your projects have a hell yes element to them as well, because you want a specific kind of, you're a buyer as well. Like, you're selling debt, you're buying you're buying in, and you take a debt position on those projects. So it is, if you stand back for those listening, you think about the relationship of capital flows and the difference you're able to create by providing value adds like experience, like process, like rigor, right? That begins to solidify the probability of bad things from happening.
Right.
And that's the business of banking. The business of banking is prevent bad things from happening.
That's right.
And so, and then when you go to market for the debt provision perspective, now you're seeking projects that have a specific affinity to how you committed to your investors, and what that's going to deliver that return, and where you guys are able to maximize, where you guys are uniquely incredible. I just think it's like, when you say that out loud, sometimes it's like, it feels like it's a shell game, but it's really just a de-risking of capital and a commitment to cash flows on one side, and a de-risking of capital and a commitment to funding on the other side. And the magic, the sausage machine is understanding what the investors, your investors, want, and then how the builders create value within their capital. Because everyone's allowed to take, if you make more money along the way, you're allowed to take your share of that more money.
Of
The
course.
builder sells it for more or rents it for more. They're allowed to make more money. You guys create more value. You're allowed to make more money. And then the investors, their job is to provide more capital. And if they do it well, they're allowed to make more money. And it's all totally fair to make more money. And that's the part that's super interesting about banking and debt is because you're allowed to make more money or you're not, but you're allowed to make more money if you keep doing this repeatedly.
Well, that's 100% right. And listen, and that is, I think you hit on a really important couple of points here, Guillermo, right? So the first one that you talked about is exactly right. It's an ecosystem. We call it the stream of commerce, right? So you think about it, from I mean, in its simplest explanation, right? You have a 401k or you have an IRA, right? You're looking for a return on that investment, right? You've got to hit a certain coupon so you can fund your retirement. So the custodians of those dollars put those dollars into pools, and now they're looking for some place to deploy that capital as well. And if they do so successfully and hit their hurdle, they're going to make a management fee, right? And so they earn a management fee. And how do they do that? They do that by finding, the alpha that they need to get. So if they need to return X% to their investors across the board, then they need to yield Y%, right? So they're going to look for other asset managers that can deliver on that. And so we come in and say, all right, well, construction financing tends to cost around this particular bracket. And so, that bracket creates alpha to you in this form. And then obviously, yes, we take what is essentially, in many of our agreements, it is literally an asset management fee. Right. Mm-hmm. And so, and so that's where we pick up our alpha. And then look, if we don't do our job, we don't get paid. But to your point, it's consistency, right? And so the only way this business works is consistency, and it's consistency across the board, right? So again, going back to that stream of commerce, that dollar that's in the system or in the stream rather, right, as it's floating down that stream, it needs to, every time it's touched, it needs to be sort of caressed and loved on, right? And so that's where, right. And that's where we come in, because if we don't provide that value, we're going to, on both sides of the equation, and you hit it nicely, right? It's a balance between we're able to provide value to the investment side of our business, and we're able to provide value to the borrower side of our business, right? And we do both consistently day in and day out. So the fundamentals of what we do and what we've been doing, I don't know, 14, 15 years in the C-suite at this point, right? What I do today is not fundamentally different from what I did the day I stepped into the C-suite, right? It's the same. Sure. The same thing. It's that consistency. You talked about one thing, that sort of banking thing. We're not exactly bankers, we're asset managers, but the mantra is the same. Don't do stupid stuff. It's just like don't, right? Yeah. So we don't chase the market to the bottom. We don't do esoteric stuff. We don't allow over leveraging. It's a very consistent. The product that we put out on the street is the same product that we've been putting out on the street for 15 years, right? And so, and that consistency is important to all of the markets that we face throughout that sort of ecosystem that you described, right? It's important to our investors because they see that consistency and they know that we consistently deploy. It's important to our borrowers because our borrowers know, hey, listen, you know what? I got an LOI from RWA Group. I know that LOI is good. And it looks exactly like the LOIs that I've been getting from these guys since they started 2.5 years ago, right? It doesn't change. I respect innovation very much, right? And we're always trying to innovate. We're always trying to get better. But innovation doesn't come from chasing a market. Innovation comes from improving a market, right? It doesn't come from, this isn't tech. We're not gonna run fast and break things, right? Because we don't have that luxury. We're gonna move slowly, not slowly, but we're gonna move consistently and deliberately.
Yeah. Yeah. Well, because then the more consistently you operate, the more zeros you can add to each end of those equations, right? Because the more you can raise, the more you can get paid, and the more you can lend out, right? Or get lend out, and the gap in that is get paid. Because ultimately, that's the part of that's the beauty of capitalism, is that you're repurposing capital, you're upgrading capital. I'll put it that way, right? You're upgrading capital. So way that, because money in a fund doesn't really do much.
Right.
But you want to get more than that because you've got to de-risk relative, portfolio theory states you've got to be able to be an allocator and put your assets in certain categories so you get the better returns, because not every category doesn't succeed. And so right?
And that goes back to that concept of strategic partnerships, right? Look, we want our borrowers to succeed, obviously, right? I mean, it's axiomatic that a successful borrower is going to be, it's going to repay successfully, right? And so we want to put those tools in the hands of the people who need them, right? So our borrowers. So we try to get creative with our borrowers, not in a crazy way, but creative in terms of approach. Okay, well, this is what you're looking to build, and maybe in this market, $2,000 a square foot works, right? But in this market, $750 a square foot or $500 a square foot works, right? And so it's really that important part of understanding the borrower, understanding their market, right? Because no two borrowers and no two markets are created the same. So it's really intrinsically understanding that, and we put a lot of effort. We have our VP, one of our VP analysts, right? This guy is, he is. His name is Peter Panos, so shout out Peter. He's a meticulous analyst, right? He really looks into markets, and he looks at data points. I mean, if you see this guy's spreadsheets, right, they're just their next level. And so he's doing what a true analyst does, really understanding the market, really understanding, the value add, right? So that now we can go back to our borrowers and say, hey, listen, Guillermo, okay, you're building this project in LA. Have you thought about this, right? And really, and you may say, hey, you know what, I didn't think about that, but okay, that makes sense. So that's where we try to be a value add to our borrowers, to be that partner, to say, hey, look, we're not going to give up the trade practices of each one of our borrowers, but we can tell you generally what we've seen that's worked. And so, for this to mark, whether you're building, AUMs or whatever it is, alternative ADUs, right? Whether you're building ADUs or you're building a new type of multifamily, or you're trying to build whatever. But the point is, knowing the market is a value add for us. It's a value add for our investment partners. It's a value add for our borrowers.
Well, it's a nice little thing because everybody wants to be de-risked,
right?
And you guys are an aggregate information because you see more deals than the individual deal maker. Right. So why not share that de-risking understanding? Because there's no benefit to you hoarding that information, right? Like you want to make sure that if it's a good project and it's fully de-risked, or it's appropriately de-risked, then you're able to have conviction that that's going to fulfill its commitments and its term. Because in a 12-month period for a loan period, like a lot of shit can happen.
A lot can change. 100%. We talked about that. We talked about that in Scottsdale, and we got a kind of interesting conversation about like sort of trying to see around the corner, right?
Yeah.
Okay, let's look at what the fundamentals are. Let's look at what's driving the market. And one of the guys across the table is like, well, I mean, I like kind of rose-colored glasses, and he wasn't wrong. But I'm like, look, dude, my market and your market are different markets, right? So in other words, if you're on the sales side, right, you're looking at completely different. If you're a real estate salesperson, you're looking at a different set of fundamentals than I am as a lender, right? So, you're thinking,
he's insurance. He's selling. He's an insurance in Florida.
Oh, that's right. Insurance. Sorry, that's
right. And so that's like
super cool guy.
That's a fine line. Insurance in Florida is. I don't know the business at all, and someone's gonna flame me, but it feels like it's like red, black, or green. Like it's like it can be that deliberate. You don't know what you're going to get.
Listen, I don't try to understand the insurance market really in any state anymore. I've given up that a long time ago. Leave it to the experts, like the guy that's across the table.
It's one of the industries that I wish I gotten into like a long time ago, because it feels like it's like as you get more in your career and you're paying for more insurance, I'm like, I get it now. I get this. I get like the buying part of it, not the selling part of it.
That's right. Yep, exactly. Yeah. And so, it's so again, and, this goes back to sort of what we, kind of what we were talking about, I think we talked a little bit about, how do we see housing demand over the next, I forget what it was, call it the next
10 years.
Yeah. 10 years. Right.
We've got the millennium gap that we're trying to close. Right. And so it's kind of like a bit of a generational, curve that we're trying to fulfill. No, and for a separate show, like, I'll be curious to see how the curve fulfills itself, because we don't want to have a bunch of empty homes. But I think it's going to backfill itself. We're not going to be in a position of empty homes. Like it's interesting to go look at like the Midwest and the older product that's in like the Ohios and the Pennsylvanias and the Illinois of the world, and see how that's kind of not being backfilled versus the smile states that are really getting backfilled, and how that's going to work. But then you also see interstate migration, kind of like doing its own job, where people are actively moving out of the Illinois into the Arizonas and taking all those units and guess what's happening now is we're getting a rebirth. It's like a rainforest. We're getting a rebirth of the Midwest because there's affordability there. And it's affordable because people moved with their dollars. And it's kind of a beautiful thing to stand back and look at it, because it looks very much like a Mother Nature thing, right? It's like, it's just big data and people moving by choice. It's the invisible hand just doing its job.
I agree 100%. We talk about, Florida's a great example, right? So, once upon a time, Florida was a low cost, low wage state, right? Now, Florida, especially south of I-4, Florida is a high cost, low wage state. And so there's coming a point where there's, I think Miami, I read a week or two ago in the Journal that Miami-Dade County is the #1 cost burdened county in the country. And so what that means is that the average person, and not average, right? So there's a huge distance between average and not average in Miami, right? Mm-hmm. It's a big
well,
delta.
Yeah, in Miami you've got international. It's an international market, so people come there.
Yeah, that's right. But still, like, housing cost burdened folks, which means the threshold is 30 roughly 33% of income or more having to go for housing costs. In Miami-Dade County, the percentage of folks that have 50% or more going of their income going to housing costs is substantial. It's unreal. Wow. So the reason I point that out is because, to your point exactly, at some point, if it hasn't already happened, it will happen. That creates an out-migration phenomenon, right? Mm-hmm. And so, and you've seen that, you got to cut through a lot of noise, right? Because everything that you read now is so politicized, so to remain politically agnostic which is what we try to do. And it's like, let's just focus on the facts, man. We're money guys, right? I mean, politics is politics.
Yeah,
right?
Yeah. Money doesn't vote.
Right. So the money unless there's an influx of affordable housing, right? And even affordable is debated, right? So, we think affordable as, 125% above the poverty rate for a given, MSA, right? But you could think of it that a bunch of different ways, but it doesn't matter until the affordability issue is solved for some of these areas like Miami-Dade County, right? You're going to see an out migration. It's inevitable because people literally
it runs out of air. It just runs out of oxygen.
100%. And so, what does that do to that underlying market, right? And to your point exactly, people vote with their pocketbooks. I mean, they always have, and they always will. I mean, people voted with their pocketbooks during the Dust Bowl era of the Great Depression and left Oklahoma, right? And, and a lot of those folks moved to California. And even, and right after that, we had the Great Migration where, millions of people left the agrarian southern states and moved to the industrialized northern states, right? So, I mean, this is, to your point, this is not a new thing. It's not a new process, it's going on for a very long time. And I think it'll continue to do that. And so, you have to think about where demand is. We still think, and I'm personally very bullish on areas like, Columbus, Charleston, and Greenville, South Carolina, right? Charlotte and the Research Triangle in North Carolina, Nashville and Tennessee, and to a lesser extent Memphis. I mean, so I'm, and obviously we're talking in a lot of issues. Some of those are infill development, some of those are scattered sites, some of those are ex-urban development. The fundamentals are the same, right? It's driven by cost.
Mm-hmm. Mm-hmm. I think there's an interesting transfer of wealth that's occurring kind of behind the scenes between boomers and millennials. Well, and in between everything in there, where it actually makes a ton of sense to liquidate your home in Connecticut and go live in Charleston, South Carolina, and enjoy your life and rent from, one of your customers, because like they're building good homes. It's a good life. And it's quite easy. Right. And
I want to touch on that for just a second, because that's an interesting thing too, right? So we talk about, when we're talking to our borrowers about exit, right? Feasibility. Okay. So I mentioned earlier, millennial is a great example, right? So, to a lesser extent Gen Z, but as that population's aging out, and being part of, family formation, there is it used to be in this country that being part of a permanent rental class was a demerit, right? Okay.
It was not the American dream.
No, but now, there are a lot of folks that are millennials and Gen Z, that I talk to that, at various conferences and so on and so forth, have no interest in being a homeowner. They're like, listen, man, owning a home is a pain in the ass, and it can be, right? I mean, every time you turn around, you got to fix something. And look, I mean, I live in a 3-year-old house and I've already had to replace an air conditioning unit, right? And so, I mean, it happens. And a lot of folks just don't want to deal with that, right? So before 3 years ago, I wasn't even aware of the concept of a multifamily, horizontal multifamily. Now I see them all the time. They're basically subdivisions that are all for rent homes. And a lot of folks, if they've got a predictable number of whatever it is, 2,500, 4,500, whatever that number is, but that gives them 1.5, 2.5, 3.5 baths or whatever it is that they want, but it's a fixed cost. And if something goes wrong, they just pick up the phone and call the property manager. That's what they want. And then when that lease is up, hey, man, if they decide that they want to relocate from Houston to Charleston, they do it. And there's no
I did a paper for Brookfield like 3 years ago. So the residential construction side. And the concept that we were talking to them about then was about home seekers. So rather than calling them home buyers or renters, the same way, like when you go, a car dealership doesn't call you a car buyer and a car leaser. Right. You're drivers. They're drivers. We had 4 drivers come in today, 10 drivers come in. They're drivers. And that's all that matters. And so the concept we were kind of talking with BRP was around, hey, there's home seekers in the world, and home seekers have more choice than ever before because they have different qualifications that they're seeking for. And they do have a lifestyle, they prioritize lifestyle. And maybe the wealth building opportunity isn't there as much as it was in prior generations. And maybe they're being quite calculated about it. I mean, those are all subject to other conversations, but like the argument is saying that it's a home seeker now. How they pay is really irrelevant. How they finance it is really irrelevant. This is where I wish the lawmakers would get their head out of their ass, because it's got nothing to do with how they pay. Right. It's got to do with where they live and how they have to do their lifestyle. And so if you consider, that's the part that's just driving bananas, like especially what's going on in Ohio right now. Like, I'm like, come on, you guys, like this, you're making it harder to provide access to domiciles that people want to choose to live in. Right. And
I think that's a great point, Guillermo. And listen, this goes full circle in terms of what are, this is the beauty of our borrowing base, right? I mean, these are folks that look, they're solving the housing crisis. They're agnostic, a lot of them, about whether it's a for sale exit or a built to rent exit. I mean, there's a little bit of everything, and that built to rent before 4 or 5 years ago wasn't really a big thing. And we go back to the very beginning of this conversation. Interest rate increases in consumer loans changed that dynamic fundamentally, right? Before that, it was, you saw a lot more build to sell inventory. Now you're seeing more build to rent inventory or different types. But that B2R, that build to rent market is not going to go anyplace, because you're absolutely right. Home seekers. And I think I'm going to rip that off.
Do it. You got it, man. It's all yours. Home seekers. They're home seekers. And they're home seeking because they've reached a certain point of their life that the apartment alternative is not practical. Right.
For whatever reason, right? Either it's affordability or it's down, or it's maintenance cost, or it's insurance, or what have you. Yeah, but it's something.
And I think that's the interesting thing that I wish lawmakers would get their head of their ass, because like constricting capital, for starters, I mean, like tariffs notwithstanding, like it is not. There's been very little economies that have been successful in. A great example: Minneapolis, St. Paul. I don't know if you're familiar with this. So everyone knows Minneapolis, St. Paul, right? Basically sister cities, great place to do an experiment, right? In the 2020s, Minneapolis opened the doors to development and construction. St. Paul introduced rental controls. Right?
And Minneapolis was the first state in the country to abolish single-family zoning.
There you go. And so what happened? Capital crossed the river, like literally just marched across the river, and Minneapolis grew. St. Paul's on the collapse. They've got empty streets. They've got empty homes. Now they've got a taxation crisis, and it is so hard to save a city if you've lost it.
Oh yeah,
it is so hard to save a city, and so unintended consequences of those that legislation has lost part of a city and has bolstered the one across the river, 100%. And it was not engineered or intentional that way. It was out of best intentions, but like the wrong thing happened. And so like, we don't have to go too far to find the social experiment and the financial experiment, the legislative experiment, financial outcome, and the social result of those kind of things. And so it's just like, it's very, I mean, you feel Machiavellian when you kind of look back at it and kind of like take it all in, but there's truths to how this all operates. And capital has choices. 100%. It can invest in something else. And so it's just, this is why I'm so thrilled we got a chance to connect and chat with everyone and share your experience around capital. Because like capital is it's a magical thing.
Yes.
And it really, and in real estate has the benefit in that you can borrow up to 80%, up of an asset valuation and lever up your capital. $100 in real estate terms can equal $500 of assets, whereas $100 in non-conventional is $100. And so like that is a magical thing when you consider that $500 could increase by 4% next year, and you get to pick up that delta. And that delta on the I'll say 5%, make it easy. That's $25 right in your pocket, right?
100%.
And that's like really beautiful about real estate, and which is why it's so incredible to work with people in real estate, is that they get that opportunity that no one else has.
Right. Yeah, I agree. Listen, I've been in the real estate space my entire adult life, my entire career in one iteration or another. And I say I can't think of anything I'd rather do. The truth of the matter is, I would rather be a rock star, but then I would have to be young, good looking, and have talent. And since I'm dispossessed of all three of those things, I'm here with you. No offense, but
there you go. So you're a banker. Here we are today. Well, this has been wonderful, man. So two final questions to close it out, because I know we're going today. First question. What kind of advice would you give yourself if you go back and look at your career, look at your life, look at a younger self, maybe someone who's just joining into your firm? What kind of advice do you offer up for guidance?
Oh man, how much time do you have? No, I think very briefly, I think I would have figured out a way to go to law school 10 years earlier, because I went to law school in my career, and and I would have found a track to private lending a lot faster than I did, right? And so two things that were game changers in my career and my life. I'm very glad they happened, but I wish they would have happened earlier.
Yeah. All right. And law school, because of why? I've got my own reason, but I'd love to hear yours.
It was very simple. It was, the company that I worked for sold. There was some nice distributions. I wasn't a stakeholder or anything, but there were some nice distributions, and I really sat there and thought about what I wanted to be when I grew up. I was in my late 20s at the time, right around 30, and I was like, all right, what do I really want to do? And I kind of looked out on the landscape of my life, and the Mount Everest that I saw in the distance was becoming an attorney. No one in my family had ever done it. We never really had the means to do something like that. So I was like, all right, this is what I'm going to do. I went out and did it. Hardest thing I ever did. I just sat out of the marketplace for almost 5 years in order to accomplish it. Hardest thing I ever did, best thing I ever did.
I wish I was more acute in law now, strictly because I wish I could read contracts better. I wish I could write contracts better. And I still, I just can't follow it. I just can't. The structure doesn't lend to my brain. And that's the one thing I just wish. I'm grateful that I've got lawyers in my network, and I've got lawyers that are good friends of mine, but I just cannot, and I'm getting better at it, but it's a practice thing. You have to read a lot of contracts.
They tell you when you start law school that they're going to completely reprogram your brain, and they do. It's just, it's a fundamentally different way of thinking.
Yeah. That I get. And I don't know if I would have been a good lawyer, but I think I'd like to. Well, I appreciate that.
Persuasion goes a long way in this field.
Yeah, no, okay. And then the next one is like, I would. Private debt is. I had a good conversation with a buddy of mine who's been in the equity side for at least 3-4 years, and obviously where I live, debt is a huge business, given the levering up for energy businesses and stuff like that, and asset-based industries. But like the debt thing, to me, it's always felt like it's been a bit cloaky, like it's been something that no one talks about, but it's still around. And then more and more that I learned about private debt, I'm like, oh, this is fascinating.
Right.
So I appreciate the conversation today, both from my own learning and everyone that's listening today. And man, and then the last question is, who should we have on next?
I was thinking about that, and I think that there are a couple of pieces you talked about that are really interesting. I want to leave with this, kind of talking about the law of the space, right? So it's a really fascinating space. I think that a couple of my good friends, either Nima or Kevin at Fortra Law, who also run Lightning Docs, would give you a great legal perspective into kind of how this business works mechanically from their perspective. Yeah. Right? So these are the guys, you talk about writing contracts, right? These guys have taken it to the next level. Not only do they write contracts, they literally write the loan documents that most major players in our market utilize, right? That they're actually like the sort of the go-to. There are a couple of great, providers out there, right? And I'm not disparaging any of them, right? I just happen to have known Nima and Kevin a long time. Again, Fortra Law is company or their firm. Lightning Docs is their document thing. These guys get insight into, a lot of the stuff that happens in markets that the public doesn't really see or doesn't even think about, right? So I think either one of those guys, and Kevin runs a podcast. Don't worry, it's not a competitor of yours. It's a completely different thing. It's for nerds like us, but anyway, but either one of those guys I think would be great to have on your program.
Oh, I'd love to. I'll reach out to them, and if they ignore me, I'll get them a boost. I'll get a boost from you.
I can make an intro.
That's awesome. Thanks, Derrick. Well, look, thanks for listening today. Thanks for sharing today. Thanks everyone for listening today. This was super interesting as you dig into the fundamentals of the business that we're in, and ultimately things that affect every single one of us that's out there in this industry. And even I think the beauty of it is also personally, right? This is not only a personal, a work conversation, it's a personal conversation. Thank you for that. I've got a page and a half of notes here. I can't wait to write this up and listen to it. But I think there's interesting things around here around like your point about, I wish I would have gone into law school earlier, like getting those kind of like that and solidifying, capstoning your understanding at the time. And obviously private debt, it's a fascinating thing. I think there's tons to work on there, and appreciate all of your kind of perspective and insights on just the curve that we're in right now. Because it feels, I really believe we're going to look back at this and it's just going to look like just like one more, it's just going to be one more, just like arc within the arc. It's not going to feel, it just feels a little, I don't know. Here, I'll leave with this. Did you skateboard growing up?
I did.
Okay. I skateboarded too. And when you skateboard, you had your skateboard set up in your kit. And as you got going pretty fast, you got a thing called the speed wobbles.
Yep.
And the speed wobbles can do one of two things. It can take you down and skin your knees, or you can battle through it and get really steady and really resolute and work your way through the speed wobbles. I believe we're in a speed wobble, and we're just going to get going faster. And there are going to be some wipeouts. And that's just,
you know what? I certainly had plenty.
Yeah, exactly. So I think that's really
skin knees and a chipped tooth. I remember that very well.
There you go. And that's how you learn, right? That's the value of experience. So I really believe we're just in a bit of a wobble, and the uncertainty we have is it's guttural. It's opinion, not fact. And we make decisions based on opinions, but it's there. And I'm thrilled for 2026. I think we're gonna have an incredible year, and it's gonna be really, really exciting. From our side, it's my opinion that I've been sharing openly, is that we're going to get into a world where the adults are in the room. We're going to be operating things with effectiveness. Folks like debt capital providers are going to be asking questions that are uncomfortable. They're going to force people to rethink how they've been doing things. And I'm really bullish on the whole machine is going to get more efficient, and it's going to start with the money. And I'm really, really excited. So thank you for sharing everything you had today. And again, everyone who's listening on LinkedIn, if you guys catch this after the fact, please add any comments. We'll catch anything there. And then the back end of it in the podcast, any comments, any like and subscribes, we'll make sure the notifications are there again. Thanks, Derrick.
Check us out at rwagroup.io.
rwagroup.io, or reach out to Derrick on LinkedIn and see what looks different. I think that's the interesting point that you brought up in terms of like, if you're a capital distributor, check them out. And if you're seeking to borrow for your and you have some experience building, and you're seeking to talk to somebody that has capital to deploy, take a look at them. I think that'd be exciting. That'd be an exciting outcome of this conversation. Wow. Wonderful. Thank you, sir. Have a wonderful day, everybody, for listening, and goodbye.